Today, we're going to pull back the curtain on a hidden financial system, one that keeps our world running, especially after a crisis. It's called reinsurance, and it's basically the insurance you probably don't even know you have. But let's start with a big what if. Imagine a massive hurricane, a devastating earthquake, you name it. What if a single one of those events was so huge, so costly, it could completely wipe out your insurance company? Just gone. All those promises to pay claims would vanish. Well, to stop that nightmare scenario from ever happening, there's actually a brilliantly simple solution. Insurance companies, they get their own insurance. And that's the core idea we're going to unpack today. Which brings us right to our first section. We're talking about insurance for insurers. It sounds a little strange, but that simple phrase describes a massive, massive global industry. So what is it officially? Well, reinsurance is basically a contract. One insurance company, they call it the ceding company, essentially hands off or cedes a piece of its risk to another company, the reinsurer. And in return for taking on that risk, the reinsurer gets a slice of the premium. So just to make it super clear, you've got two main players in this game. First, the ceding company. That's the primary insurer that wants to offload some risk. And second, the reinsurer. That's the company that accepts that risk. For a price, of course. It's really just a straightforward transfer. Okay, but why bother with all this? Before we get into the different ways they share risk, it's really important to understand why it matters so much. Reinsurance basically builds the pillars of stability for the entire insurance world. And the benefits here are just huge. For one, reinsurance gives them increased capacity, which means they can take on more customers and insure more people. It also provides catastrophe protection, that safety net against a single nightmare event. It also helps stabilize their finances year to year, and as a bonus, gives them access to the reinsurer's deep, specialized knowledge. So how do they actually do this? How do they share the risk? Well, it really boils down to two main approaches. The first is called proportional, which is kind of like splitting the bill on every single policy. The second is non-proportional, which acts more like a safety net that only catches you when a loss gets really, really big. Let's dig into that first method, proportional reinsurance. The key idea here, just like the title says, is pretty simple. It's all about sharing the bill. A perfect example of this is something called a quota share agreement. Let's say it's a 50-50 split. The reinsurer agrees to take on half the risk of a policy. In return, they get half of the premium that the customer pays. And then, if a claim comes in, you guessed it, they pay for half the loss. It's a very direct, very predictable partnership. Now let's look at the other approach, non-proportional reinsurance. See, this isn't about sharing every little thing. This is about putting a cap on a potential loss from a major disaster. This type of deal is usually called excess of loss reinsurance. The way it works is the main insurance company sets a retention. Think of it like a deductible. Let's say it's $1 million. They're saying, we can handle any loss up to $1 million on our own. The reinsurer only steps in and starts paying for losses above that amount, covering everything in this example up to $5 million. They only get involved when a loss breaks through that ceiling. So let's just quickly put them side by side. With proportional, you're sharing everything by a fixed percentage. The risk, the premium, the losses, and you're mainly doing it to increase your capacity to write more business. With non-proportional, the sharing only kicks in after a loss gets big, and its main job is to protect you from those huge, catastrophic events. All right, let's zoom out now and see what this all means for the real world. Because when you put all these pieces together, this system creates a truly global safety net. When a catastrophe hits, reinsurance is what keeps the entire system from collapsing. It spreads the financial shock across the globe, so one event in one place doesn't bankrupt a local insurer. It pumps in cash so claims can be paid quickly. It's what allows us to insure gigantic things like oil rigs and stadiums. And ultimately, it brings financial stability right when we need it most. I think this quote from our source material just says it all perfectly. Reinsurance is a fundamental pillar of the insurance industry, providing essential financial protection and risk management capabilities. It's not just some obscure financial tool. It's really the bedrock that lets the whole system work. But all this brings us to a final and pretty critical question for our modern world. The whole system works by spreading risk out geographically. So what happens when a disaster, like a global pandemic or a major climate event, is truly global? What happens when everywhere needs to file a claim all at once? Well, that's the billion-dollar question and the challenge for the future of insurance. Thanks for tuning in.